Imagine you're at a poker table. Everyone else is playing with the same basic strategy they learned years ago. Collect income, sacrifice growth. But there's one player who just figured out how to collect the same income and keep most of their growth potential. That player just won a $349 million pot, and I'm about to show you exactly how they did it. Because what I'm about to reveal isn't just another investment tip, it's a complete game changer that's making some investors 6% more than everyone else. And the best part, most people have never even heard of it. Meet Sarah, a 45-year-old teacher who wants steady income from her investments. Like millions of Americans, she discovered covered call ETFs. They promise 10% yields by selling call options on stocks. Sounds perfect, right? But here's the catch: Sarah learned the hard way. While her dividend checks came in every month like clockwork, she watched her friends' regular index funds grow 20% while hers crawled along at just 8%. She was essentially trading her future wealth for today's income. On a $100,000 investment, that's the difference between ending up with $120,000 versus $108,000. That $12,000 gap? That's real money Sarah lost by playing it safe with traditional high-income strategies. This is the great dividend dilemma every income investor faces. You can have high dividends or you can have growth, but conventional wisdom says you can't have both. But then Sarah discovered something that changed everything. A fund manager in New York had cracked the code. Instead of choosing between income and growth, he found a way to get both. This isn't just another covered call ETF. It's like having a Swiss Army knife when everyone else has a butter knife. While traditional covered call ETFs like SPYI delivered 34% returns, this revolutionary strategy delivered 40%. That's $6,000 more on every $100,000 invested. The fund I'm talking about is Bali, the iShares Advantage Large Cap Income ETF. And here's what makes it so special. It doesn't just generate an incredible 8.71% dividend yield paid monthly. It also managed to deliver over 20% in price appreciation while its competitors struggled to hit 8%. This means the fund's net asset value actually grows and recovers during market downturns, which is crucial when sudden sell-offs happen. So how is this possible? How can one fund deliver such strong total returns while still managing risk and paying out nearly 9% in dividends? The secret lies in three revolutionary pillars that most investors don't even know exist. Let me break this down for you in simple terms because once you understand this, you'll never look at income investing the same way again. Pillar 1. The concentration advantage. Think of most ETFs like a huge cafeteria buffet, 500 dishes, but most are mediocre. Bailey is like a premium restaurant with only 180 carefully selected dishes, each one exceptional. While the S&P 500 holds 500 companies, Bailey holds just 180 of what they believe are the strongest performers. This concentration gives it a massive edge because you're not being diluted by hundreds of positions that may not perform well. It's the same reason why funds like QQQ tend to outperform the broader S&P 500. When you focus on the best companies, you often get better results. But here's what's really smart about their selection. They're not just randomly picking 180 stocks. They're strategically overweighting the sectors that drive growth. Technology makes up 31.14% of the fund. That's where innovation and growth happen. Financial services accounts for 12.86%. Consumer cyclical is 11.65%. Healthcare is 10.69%. And communication services rounds out the top 5 at 10.27%. Compare this to a typical S&P 500 fund where technology might only be 25 to 28%, and you can see why Bali has that extra growth potential. They're betting bigger on the sectors that historically deliver the strongest returns. Now yes, more concentration usually means more risk, but Bailey has found that sweet spot where concentration enhances returns without letting risk spiral out of control. Pillar 2. The future's secret weapon. Here's where it gets brilliant, and this is something I've never seen used in a high-income strategy before. Instead of buying expensive ingredients, the actual stocks, they use futures contracts. Think of it like putting down a small deposit to control a luxury car instead of buying it outright. This frees up massive amounts of cash to make even more money through options. Now you might be thinking, Don't options also provide leverage? Yes, but here's the crucial difference. Options are like ice cream. They melt over time through something called theta decay. Their value diminishes as you get closer to expiration. Futures are like frozen yogurt. They don't melt, they just roll forward to the next contract period. Options are also heavily affected by market volatility, which makes them more expensive during turbulent times. But futures pricing is cleaner and more directly tied to the underlying index. It's simpler. You're either long or short, bullish or bearish. That simplicity is part of why hedge funds use them for efficient exposure. In Bailey's case, their S&P 500 futures position accounts for around 24% of total assets, giving them the same exposure as if they owned $84 million worth of S&P 500 stocks directly, but with much less capital tied up. Pillar 3. The AI-powered selection. While other funds pick stocks like throwing darts at a board, Bailey uses quantitative models, like having a supercomputer analyze every player's stats before drafting your fantasy team. According to their prospectus, they use proprietary return forecast models combined with quantitative analysis methods. In simple terms, the fund managers aren't just passively tracking an index. They're using sophisticated tools based on metrics like earnings, valuation, cash flow, dividends, and momentum to identify what they believe are the strongest performing stocks. Now, I'll be honest, this part is somewhat vague because we don't have access to their exact formula. But it's safe to assume they're using some sort of blend of fundamental analysis that helps explain why they can be so concentrated with just 180 stocks, while still managing risk effectively. Remember Sarah from earlier? If she had invested $100,000 in Bailey instead of traditional covered call ETFs, here's what would have happened. Her income would still be strong, 8.71% annually, which means $8,710 in dividends hitting her account every year. But here's the kicker. Her growth would have been well over 20% in capital appreciation versus just 8% with the old strategy. That means her total would be $140,000 versus $134,000, $6,000 more in her pocket. And this isn't just theoretical. Since Bailey's inception in September 2023, it has consistently outperformed many of its peers in total returns. The fund currently manages $349 million in assets, with an expense ratio of only 0.35%, which is incredibly reasonable for this level of sophisticated strategy. That low fee means more money stays in your pocket instead of going to fund management. Now, I'm not here to sell you a fairy tale. Like Sarah learned, no investment is perfect. Bailey's concentrated approach means more volatility than a broadly diversified index fund. And that quantitative model? It's only as good as the data it's fed and the assumptions it makes. In fact, Bailey has recently underperformed some of its peers by a little bit during certain short-term periods. But that's typical short-term noise in what should be viewed as a long-term strategy. Active stock picking can sometimes backfire, especially in certain market cycles where momentum shifts unexpectedly. The fund is still relatively new, with less than 2 years of track record, so we're still learning how it performs across different market conditions. And because it's actively managed rather than passively following an index, there's always the human element and the possibility that the strategy could change or underperform expectations. So here's what I want you to do. Don't just take my word for it. Look at your own portfolio right now. Are you stuck in the old income versus growth trade-off? Are you settling for 8% growth when you could potentially get 20% while still collecting nearly 9% in dividends? Or are you ready to explore strategies that could give you both income and appreciation? I want you to comment below and tell me, what percentage of your portfolio is currently in high-income ETFs? Are you prioritizing dividends over growth, or have you found a way to balance both? And if you're intrigued by this strategy, let me know if you want me to dive deeper into the mechanics of how futures contracts work in future videos. Hit that subscribe button if you want more strategies like this that challenge conventional wisdom and show you what's really possible when you think outside the box. And smash that like button if you learned something new about futures, options, and how modern ETFs are evolving to solve age-old investment problems. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching!